All right, let's widen out, take a look at the bigger picture with Thomas Raymond, partner at Callan Family Office. Thomas, thank you so much for joining us this afternoon. I'm curious to know your view on this. Before, when things were volatile, you had this talk about the Sell America trade. Before we are where we are now with this risk-on move that we've seen this week, you expressed some skepticism about the Sell America trade. What was it that you saw?
Yeah, well, thanks for having me. Glad to be here. And answer your question, we were skeptical because the American ethos, the business, what drives American business wasn't changing. And yes, there were some higher multiples with international stocks relative to, or higher multiples with domestic stocks relative to international stocks. At some level, they deserve a higher multiple, which is a reflection of their future growth and their competitive spirit. And a great example of that, an untold story of that, is Amazon. Amazon trading at 31 times earning, a little bit, above market multiple. But what happened was, somewhat below the radar, was they announced Kuiper. They were taking on Starlink. And Starlink is this, has this monopolistic share of low orbit satellites. But Amazon, $650 billion of revenue over the last 12 years. They've got the firepower, the financial firepower to take that on. And in addition, this is something that they do. They're not always the first mover. They weren't the first mover into online commerce. They weren't the first mover into cloud computing, and now they're not the first mover into the Starlink, right? The low orbit satellites, and this was just missed, right? So this was our take, right? This the American competitive spirit to drive the ethos of American business was alive and well, and the Sell American trade ran counter to that. So that's why we're a little bit skeptical of that whole notion.
Okay, yeah, and look, I mean, this week we've seen quite a recovery in equities, even before now, but this week a big, it feels like almost like a round trip since what we saw at the beginning of April, and you have had a lot of deal news beyond just what occurred with China and the U.S. Now, one thing that we've heard from some analysts, their view is that the market is a little overbought. Do you share that same view?
No, we think that there's a lot of kind of fundamental growth drivers out there. I mean, the AI story is real. It's an economic unlock. It's innovation unlock. There's still $500 billion of AI investment planned. On top of that, there are going to be some tax incentives coming down the road. The big, beautiful bill, of course, that was being referred to. There's going to be a lot of powerful tax incentives that's going to drive consumer spending in this market. So we think there's still a lot of inherent growth drivers in here. Tariffs have been center stage, but if you focus on other matters, right, you focus on the competitive spirit, that American ethos, tax incentives that are coming, there's a lot of powerful forces that are still out there.
And then, Thomas, I want to ask you this. You talked about the just-in-time risk management in light of the 90-day tariff pause. Can you explain what that means?
Yes. Usually when there's a market downswing, a violent downswing, everybody becomes risk managers. Everyone kind of swings into risk management mode. Frankly, our instincts, our contrarian takes, do just the opposite, right? So we look at some of the opportunities that come to surface in those moments. Going back to Liberation Day and the aftermath of that, you had NVIDIA trading at a multiple just similar to Coca-Cola. People were coveting soft drinks or seeing the upside of soft drinks more than they were with software. So there were a lot of opportunities that came into focus. And so we just didn't, we believe in proactive risk management, not reactive risk management. So we had proper diversification going into it. It helped stem some of the losses, some of the downswing that took place. So that's what we were kind of getting at in that memo.
Okay, and then you say that bonds have been the adult in the room. Are they still the adult in the room? And what do you mean by that?
They've been very well behaved. The bond market on two fronts has been very well behaved. One is spreads. Right, so spreads gapped out just a little bit after Liberation Day, but now they've come back down. They've calmed out, so you kind of had that, not as much of emotional reaction. And then two, you have break-even inflation rates. They're hovering around 2.3, 2.4%, very well behaved, very kind of not very stable, far below where they were in 2022 when they peaked out at 2.9%. So they've been very well behaved, but also telling of a couple things. One, the bond market's saying, inflation is not going to be entrenched. And two, not a lot of elevated business risk as evident by spreads.
All right, Thomas, thank you so much. That's our Thomas Raymond, partner at Callan Family Office. Thank you so much for your perspective. Have a great rest of your Friday and weekend.